Have you ever wondered why a country swimming in some of the world's most valuable natural resources has a currency that seems locked in place, unable to reflect the sheer volume of black gold flowing from its wells? Imagine an economy so single-mindedly focused on one commodity that its entire financial health, the very value of the money in its people's pockets, rises and falls with the global price of a single barrel of crude. This isn't a theoretical economic model. This is the daily reality for Iraq, a nation whose identity and future are inextricably woven into the fabric of the global oil market. For anyone tracking the Iraqi dinar, understanding this relationship isn't just helpful, it's absolutely critical. The story of the dinar is a story of oil, and today we're going to unravel that complex and often misunderstood connection, starting with the staggering scale of Iraq's oil production and the seemingly paradoxical stability of its currency, a stability built not on economic diversification, but on a relentless flow of petroleum that commands billions upon billions of dollars in revenue year after year, funding the state and propping up the dinar's value through a mechanism designed to prevent the kind of wild fluctuations that would otherwise cripple an economy so dangerously reliant on a single, volatile export. The numbers themselves are almost difficult to comprehend. In just the first 8 months of 2025, Iraq, OPEC's second largest oil exporter, produced a colossal nearly 1 billion barrels of crude oil. To be more precise, the total output reached around 964.9 million barrels, with the vast majority of this wealth flowing from the rich fields in the southern province of Basra. When it came to exports, which are the true lifeblood of the economy, countries shipped out roughly 20 million barrels to the world market. The month of August alone saw production peak at 124.47 million barrels, exports hitting 104 million barrels for that month. The revenue generated from this immense undertaking was a staggering 73.82 trillion dinars, translated into approximately 56.3 billion flooding into the country's coffers. This figure represents nearly 90% of Iraq's total government income. A shocking statistic that lays bare the fundamental structure of the Iraqi state. It is a petrostate utterly dependent on oil. This relentless export machine continues month after month. For instance, in May of 2025, Iraq exported over 1 million barrels of crude, earning another 6.36 billion in a single month, demonstrating the consistent and massive scale of this financial inflow. So where does the dinar fit into this picture of oil-fueled abundance? The exchange rate you see today, the one that has remained in a tight band for a long time, is a direct creation of this oil revenue. As of late November 2025, the exchange rate stands at approximately 1.3951 Iraqi dinars to $1. Over the past year, this rate has shown remarkably little movement, with a change of just 0.04% over 12 months, reflecting a deliberate and managed stability. To give you a broader view of its behavior in 2025, the best exchange rate for the dollar was 331.01 dinars back in early February, while the worst rate was 1,293.60 dinars in early August, with the annual average hovering around 1,309.79 dinars to the dollar. This stability is not an accident. It is the result of the Central Bank of Iraq's careful management, policy made possible by the constant stream of US dollars earned from oil sales. The government needs these dollars to function. It pays for everything from public sector salaries to massive infrastructure projects in dinars, but the original revenue is in dollars. This creates a constant, managed system where dollars are converted to dinars to fund the budget, ensuring a steady supply of both currencies and preventing wild swings. The system is so effective at maintaining the status quo that over a typical week, you might see no percentage change whatsoever in the dinar's value, with the rate appearing locked in place. This managed stability is the key takeaway. The dinar's value is an administered price, not a freely floating one, and the administration is funded by oil. Every single barrel that Iraq pumps and sells on the international market directly reinforces this financial wall, ensuring that the dinar you track doesn't suddenly spiral out of control. This very strength is also its greatest vulnerability, a topic we will delve into deeply in our next segment. But this reliance on oil is a double-edged sword, and to truly understand the dinar's future, one must look beyond the simple export numbers and examine the intricate and often fragile economic plumbing that connects the oil fields to the foreign exchange market. The entire mechanism that keeps the dinar stable is a complex dance involving the state oil company, the central bank, and the government's budget, a dance that is vulnerable to any disruption in the flow of crude or any significant dip in its global price. The system, known informally as the petrodollar cycle, works like this. The State Organization for Marketing of Oil, or SOMO, sells Iraqi crude to international buyers, and the payment is made exclusively in US dollars. Those billions of dollars in revenue then enter the Iraqi financial system. A significant portion of these dollars is sold by the Central Bank of Iraq in a daily auction to local banks and currency exchange houses, which provides the private sector with the foreign currency it needs to pay for imports, from food and medicine to cars and machinery. This auction is the critical valve that controls the dinar's supply and demand. Meanwhile, the government uses its share of the dollar revenue to back its budget, which is written in dinars. It converts dollars to dinars to pay the salaries of millions of public employees, the single largest group in the Iraqi workforce. This constant high-volume conversion, driven by both state expenditure and private sector needs, creates a predictable equilibrium for the dinar's exchange rate, an equilibrium the central bank fiercely defends by buying and selling dollars as needed to maintain the narrow band we observe. However, this system exposes the Iraqi economy and the dinar to profound risks. The first and most obvious is the volatility of global oil prices. While Iraq has been exporting at a high volume, any significant drop in the price per barrel would immediately slash the dollar revenue flowing into the country. This would force the central bank to dip into its foreign currency reserves to maintain the dinar's peg, a defense that only lasts so long if the price drop is severe or prolonged. The second risk is production itself. Geopolitical tensions, internal disputes, or technical failures can halt oil production in key regions. For example, while most oil comes from the stable south, disputes with the Kurdish region in the north over export rights and revenue sharing have previously led to shutdowns that cut off hundreds of thousands of barrels per day from the global market. Any such interruption directly threatens the dollar supply. Furthermore, the structure of the Iraqi economy means that this oil wealth does not necessarily translate into broad-based prosperity or a stronger currency. The non-oil sector remains underdeveloped, leading to a high unemployment rate, particularly among the youth. This creates social pressure forever, increasing government spending, which in turn puts more strain on the dinar as the state converts its dollar oil wealth into local currency to pay salaries and fund services, a process that can stoke inflation if not carefully managed. Looking at the data, we can see this delicate balance playing out. The latest figures show Iraq's crude oil production was 449 barrels per day in October 2025, a significant increase from the 321,000 barrels per day in September. This demonstrates the country's capacity to ramp up production, which is positive for near-term dollar inflows. However, economic forecasts are inherently cautious. Analysts expect the USD-IQD exchange rate to trade around 1.310 by the end of the current quarter and to remain at similar levels over the next 12 months, according to trading economics models. This prediction is not a forecast of strength, but rather an expectation of continued managed stability. The central bank is projected to use all the tools at its disposal to keep the rate within its current very narrow band, precisely to prevent a loss of confidence that could trigger a devaluation. For a historical perspective, it's worth noting that the USD-IQ reached an all-time high of 140.60 in December 2020, a period of immense global economic uncertainty during the pandemic. The fact that the rate is stronger now than that peak is a testament to the central bank's successful management in the face of challenges. It also highlights how external shocks can test the system's limits. The dinar's value, therefore, is not a simple reflection of Iraq's economic health, but a mirror of its oil revenue and the central bank's ability to manage the massive flows of currency that this revenue generates, a system that is robust on paper but remains perpetually one crisis away from severe pressure, a reality that sets the stage for the final most critical part of our discussion, the long-term path forward. So what does all this mean for you, the observer of the Iraqi dinar? And where does the path forward lead for a nation whose currency is chained to the fortunes of a single commodity? The undeniable truth is that the dinar's stability is an artificial construct, a carefully maintained facade built upon the powerful foundation of oil exports. Its remarkable steadiness over the past year, with a minuscule 0.04% change and an average rate hovering around 1.309 to the dollar, is a direct outcome of the Central Bank of Iraq's relentless intervention, an effort funded by the over $56 billion earned from oil in just the first 8 months of 2025. This system has so far prevented a collapse, but it has not fostered organic strength. The real long-term value of the dinar will not be determined in the global oil pits or the central bank's auction room alone, but in Iraq's ability to transcend its status as a petrostate. The conversation must shift from simply tracking monthly export figures to asking the more difficult question, when will Iraq build the refineries, the factories, the farms, and the tech hubs that can generate wealth independent of the oil sector? The government's current account, a broad measure of its international financial position, has shown wild fluctuations, and its balance of trade, while positive, is almost entirely a reflection of oil sales. True, sustainable strength for the dinar will arrive only when the country's economic pillars are diversified, creating multiple, robust streams of income that can survive the inevitable downturns in the oil market and provide jobs for the millions of young Iraqis entering the workforce. The future, however, is not without its glimpses of potential. Forecasts for Iraq's crude oil production are actually projecting a gradual increase, with some models anticipating it to trend around 450,000 per day in 2026 and 250,000 in 2027. This suggests that the primary engine of the economy and the dinar's stability is not running out of fuel anytime soon. In the immediate term, the exchange rate is expected to hold steady at around 1.310, indicating that the central bank has both the will and the resources to maintain the current paradigm for the foreseeable future. This is a precarious path. The nation's history holds a stark lesson. The dinar's value has collapsed before, from a position of strength decades ago to the hyperinflation and chaos of the sanction years, before being resurrected and re-pegged in the post-invasion era. The all-time high of 460 dinars to the dollar in late 2020 is a recent reminder of how vulnerable the currency remains to external shocks, be they a global pandemic, a dramatic crash in oil demand, or internal political instability. For you, this means that any analysis of the dinar must be a dual-track investigation. You must vigilantly monitor the hard data, the monthly oil production reports from the ministry, the revenue announcements from SOMO, and the daily auction results from the central bank. But you must also pay equal attention to the political and geopolitical landscape, the debates over the federal budget, the disputes between Baghdad and Erbil over oil sharing, and the ongoing negotiations within OPEC over production quotas, because in Iraq oil is politics and politics is money. The intricate dance between the dinar and oil is a story of immense wealth, profound vulnerability, and managed stability. It is a system that works until it doesn't, fortress built on a foundation that is constantly shifting with the tides of the global market. Understanding this is your key to deciphering the true nature of the Iraqi dinar. If you found this deep dive into the economic heart of Iraq enlightening, if it has connected the dots between the headlines of oil production and the fine print of the exchange rate, then your understanding of this complex topic has just been upgraded. I want you to put that understanding to the test. Go to the comments section below and share your perspective. What do you believe is the single greatest challenge Iraq faces in weaning its economy, and by extension its currency, off its total dependence on oil? Do you see viable paths to diversification in the next decade, or is it the petrodollar trap too deep to escape? Your insights are valuable. And if you want to continue this journey of economic discovery with me, make sure to hit that subscribe button and ring the notification bell, because we will be keeping a close watch on the monthly oil export figures, the central bank's policies, and all the economic indicators that tell the real story of the dinar. This is not just about numbers on a screen, it's about the future of a nation and the value of its money. Thank you for watching, and I look forward to reading your thoughts.